The Great Global Balancing Act. Are we heading for an economic earthquake? Welcome to our deep dive into the shifting sands of the world's economies. Buckle up. There's a lot of turbulence out there, and it's all tied to four major trends: post-pandemic recovery, persistent inflation and cost of living crisis, geopolitical and energy shock, shifts in monetary policy. In this report, we'll examine what's going on globally, take a closer look at 12 high-income or upper-middle-income countries under particular strain, and then explore some practical suggestions for navigating the stormy financial seas ahead. Let's dive in. What's happening with world economies? Post-pandemic recovery. Economic whiplash. After COVID-19 restrictions eased in 2021-2022, a sudden surge in consumer demand collided with supply chain snarls. This led to product shortages, shipping backlogs, and upward pressure on prices. Central banks versus inflation. Desperate to tame inflation, major central banks, like the U.S. Federal Reserve, European Central Bank, and Bank of England, raised interest rates aggressively. Higher rates aim to slow spending and cool inflation, but risk choking growth and increasing debt costs for everyone from governments to families. Persistent inflation and cost of living crisis. Why it lingers. Inflation isn't going away quietly. Energy prices remain elevated, labor markets are tight, and geopolitical tensions disrupt supplies of key commodities: oil, natural gas, grain. Household squeeze. From skyrocketing grocery bills to soaring rents, many households in advanced economies are struggling. Real wages, income adjusted for inflation, often lag behind rising prices, squeezing disposable incomes. Geopolitical and energy shocks. War in Ukraine. Europe, historically reliant on Russian energy, faced natural gas shortages and price spikes, rippling across global commodity markets. China-US. Tensions, tariffs, sanctions, and political spats risk fragmenting global supply chains, creating costly inefficiencies for businesses and potential shortages for consumers. Shifts in monetary policy. The dollar's rise. As the U.S. raises interest rates, global investors often flock to the dollar, making it stronger. Emerging markets with dollar-denominated debt can face heavier repayment burdens. Financial tightening. High rates mean more expensive loans, whether for mortgages, business expansion, or personal credit cards. Debt-laden countries and households feel the strain first. Which developed or high-income economies are under the most pressure? Struggling can be subjective, but we often look at GDP growth, inflation, unemployment, debt levels, and fiscal health. Here are 12 countries where the red flags are more visible than in others. United Kingdom. Key issues. Brexit fallout. Trade frictions, reduced foreign direct investment, and new bureaucratic hurdles continue to weigh on growth. High inflation. The UK has faced steeper inflation than many G7 peers, driven by energy prices and labor shortages. Stagnant growth. Forecasters predict slower GDP growth relative to other advanced economies. Outlook. The Bank of England's aggressive rate hikes aim to curb inflation, but rising mortgage costs could restrain consumer spending. Watch for further Brexit-related trade realignments and potential strikes, protests over cost of living pressures. Italy. Key issues. Debt mountain. At over 140% of GDP, Italy's public debt is among the highest in Europe, vulnerable to interest rate hikes. Structural roadblocks, bureaucracy, low productivity growth, and political fragmentation hamper reforms and competitiveness. Outlook: political turbulence has slowed momentum for structural economic reform. Italy hopes to tap the EU's next-generation funds for stimulus, but success hinges on execution and political stability. Japan: key issues. Decades of low growth. Japan faces a shrinking population, ballooning social security costs, and entrenched deflationary pressures. Currency conundrum. A weaker yen helps exporters but raises the cost of imported goods, energy, food. Outlook: the Bank of Japan's long-running ultra-loose monetary policy supports growth but also fuels concerns about massive public debt, over 200% of GDP. Any abrupt policy shift could rattle global bond markets. Turkey, often classified as upper middle income or emerging high income, but also a G20 economy. Key issues: sky-high inflation. Turkey's inflation rate has soared into the double, sometimes triple, digits in recent years. Unorthodox policy moves. Persistent low interest rates despite high inflation undermined the lira, driving foreign investors away. Outlook: without consistent monetary policy, currency volatility is likely to continue. Political changes could pave the way for more conventional reforms, but foreign investor confidence remains fragile. South Korea, key issues. Export reliance. Korea's tech and automobile sectors depend heavily on global demand. A global slowdown hits exports hard. Rising household debt. Real estate price surges have led many Koreans to take on significant debt. Outlook: policymakers are balancing inflation control with maintaining growth. The government has introduced measures to stabilize real estate and reduce overheated credit markets. Germany, key issues: energy dependence and high costs. Heavily reliant on Russian gas imports, Germany has seen energy prices soar amid geopolitical tensions. Industrial slowdown. As Europe's manufacturing powerhouse, Germany faces weakened demand in key export markets like China. Demographic pressures. An aging population strains healthcare and pension systems. Outlook: having slipped into a technical recession in mid-2023, Germany's path forward depends on diversifying its energy sources and revitalizing its industrial competitiveness. France, key issues: high public debt and fiscal strains. Elevated debt levels limit how much the government can spend in a crisis. Social unrest. Reforms, especially pensions, spark protests, sometimes disrupting economic activity. Persistent unemployment. Youth unemployment is notably high, posing social and economic risks. Outlook: France boasts a diverse industrial base, luxury goods, tourism, aerospace. The challenge lies in implementing reforms without igniting further social upheaval. Spain, key issues: high unemployment. Though tourism has rebounded post-pandemic, Spain's jobless rate remains among the highest in the Eurozone. Debt and fiscal pressures. Debt levels rose significantly after the 2008 crisis and during COVID-19, making higher interest rates painful. Reliance on construction and tourism. Economic overdependence on these sectors makes Spain vulnerable to external shocks. Outlook: EU recovery funds and robust tourism are short-term boons. Long-term sustainability requires tackling labor market inefficiencies and boosting innovation. Sweden: key issues: housing bubble and debt. Years of easy credit and rising property values have led to high household debt. Export exposure. As an export-driven economy, a global slowdown weighs on Swedish industry, machinery, tech, pharmaceuticals. Inflation and rate hikes. The Riksbank's rate hikes help cool inflation but squeeze mortgage holders. Outlook: Sweden's strong innovation culture and social systems position it well in the long run, but short-term real estate corrections and global headwinds may cause bumps ahead. Australia: key issues: housing market and household debt. Australia's household debt-to-income ratios rank among the world's highest, linked to soaring housing prices. Commodity dependence. Exports to China, iron ore, LNG, are a key growth driver. Any slowdown in Chinese demand can ripple through Australia's economy. Wage growth and cost of living. Despite low unemployment, wages haven't kept pace with high housing and living costs. Outlook: Australia has weathered past shocks well, e.g., 2008 crisis, but continued reliance on commodities and an inflated real estate market pose risks if global or domestic conditions sour. Canada: key issues: housing market and household debt. Canada has one of the highest household debt-to-income ratios among G7 nations, largely driven by elevated property prices, particularly in major metro areas like Toronto and Vancouver. Rising interest rates increase mortgage servicing costs and could cool the housing market, raising concerns about potential price corrections. Resource reliance. A significant portion of Canada's economy is tied to commodities: oil, natural gas, minerals. While commodity booms can be lucrative, they can also create vulnerability to global price swings. Inflation and rate hikes. The Bank of Canada has hiked rates to combat inflation, tightening credit conditions for consumers and businesses. Elevated consumer prices, especially in food and housing, are straining household budgets, even though inflation has moderated slightly from peak levels. Labor market and immigration. Strong immigration inflows support population growth and labor supply, helping to mitigate some workforce shortages. However, high labor demand can also fuel wage pressures, which in turn can contribute to inflation if not managed carefully. Outlook: moderate growth, real estate uncertainty. Canada's growth is expected to be modest in the near term, with potential headwinds if real estate corrects sharply or global demand for commodities declines. Policy Balancing Act. The Bank of Canada must thread the needle between controlling inflation and avoiding a severe economic slowdown, especially in housing. United States. Key issues. Interest rate trajectory. The U.S. Federal Reserve has led global rate hike cycles, raising rates to combat inflation. While inflation has cooled somewhat, the Fed's policy stance remains vigilant. Higher rates strengthen the US dollar, attracting capital inflows but also making dollar-denominated debt more expensive for foreign borrowers. Consumer spending and labor market. The labor market has remained relatively strong, with low unemployment rates in many sectors. Robust job growth supports consumer spending, a crucial driver of US GDP. On the flip side, higher wages can stoke inflation, leaving the Fed to manage a delicate balance between full employment and stable prices. Federal debt and fiscal policy. US national debt continues to climb, raising concerns about long-term debt sustainability. Elevated interest rates mean higher interest payments on government borrowing. Political divides can lead to uncertainty in fiscal policy, e.g., debt ceiling debates, potential budget cuts, which can rattle financial markets. Tech sector and shifting supply chains. The U.S. tech industry remains a global leader, but has seen waves of layoffs and cost-cutting as companies brace for tighter capital and uncertain consumer demand. Tensions with China have driven discussions around reshoring or friend-shoring supply chains, which could mean higher production costs but potentially more resilience. Outlook. Mixed signals. Some indicators point to a soft landing scenario, lower inflation without a severe recession, while others suggest slower consumer spending and higher corporate borrowing costs could hit growth. Global spillover effects. As the world's largest economy, U.S. monetary and fiscal decisions ripple across global markets, influencing exchange rates, trade flows, and investor sentiment worldwide. Where do they stand overall? Canada and the U.S. versus other advanced economies. Compared to countries like Italy or the U.K., facing high public debt or major structural overhauls, both Canada and the U.S. generally have more policy flexibility and diversified economies. Nevertheless, housing affordability, inflation, and high household public debt remain very real concerns in both countries. Strengths and vulnerabilities. Strengths. Large consumer bases, advanced service, tech industries, relatively stable political environments, despite periodic gridlock, and strong financial systems. Vulnerabilities. Rising interest rates, lingering inflationary pressures, potential housing market corrections, and exposure to global energy, commodity cycles. General suggestions for navigating turbulent economic times. While no single strategy guarantees success, here are some guidelines to help you stay afloat during choppy waters. Stay informed with credible data. Consult reputable sources like the IMF, World Bank, and respected think tanks for accurate figures on GDP, inflation, and economic forecasts. Follow policy announcements from central banks and finance ministries to gauge potential market impacts. Diversify financial exposure. Spread investments across different asset classes, stocks, bonds, real estate, commodities, and geographies to reduce overall risk. Consider stable, dividend-paying, blue-chip companies in sectors that are historically resilient, e.g., utilities, consumer staples. Manage debt wisely. Prioritize paying down high-interest debt or lock in fixed rates where possible. If you're looking to refinance, compare multiple offers for the best terms. Strengthen cash flow and emergency funds. Aim to keep an emergency fund of 3 to 6 months of living expenses, especially if your job or income stream could be affected by a downturn. Look for ways to increase your income, e.g., freelance work, part-time gigs, or cut discretionary costs if you see warning signs ahead. Consider policy impacts. Governments sometimes roll out fiscal stimulus, infrastructure spending, tax breaks, which can boost certain industries, e.g., clean energy, tech. Conversely, austerity measures or higher taxes might slow consumer spending and shrink corporate profits. Seek professional advice. Complex situations, like major investments, estate planning, or big tax considerations, may require a certified financial planner or advisor. Professionals can help tailor a strategy to your unique risk tolerance and financial goals. Final thoughts and takeaways. Global interdependence. Each country's challenges are tied to larger global forces. Shifts in U.S. interest rates, China's growth trajectory, or geopolitical flare-ups can spark worldwide ripples. Debt and demographics. Many advanced economies face aging populations and heavy public or private debt burdens, making them more vulnerable to financial shocks. Opportunities amid chaos. Turbulence sometimes yields innovation, whether in green energy tech, digital solutions, or forward-thinking policy reforms. Staying agile and open-minded can uncover hidden gems. Is a new economic earthquake imminent? It's tempting to sound the alarm on the next big crash. While certain indicators look ominous, high debt, persistent inflation, geopolitical tensions, economies are resilient, and prudent policymaking could steer us away from disaster. That said, preparedness is key. Diversify your finances, stay informed, keep calm and stay nimble. Disclaimer: this report is for general informational purposes only. It does not constitute financial or investment advice. Always consult a qualified professional for guidance regarding your specific situation. Thank you for joining this deep dive. If you found this helpful, consider liking, sharing, or subscribing, and keep watching for more insights on the ever-shifting global economy.